All right, dummies. So the first episode was kind of a dumb way to start. I didn't actually give you any intro. This is going to be the intro video, the second video of the series. The last video was kind of just showing you how the chart kind of worked to inspire you to maybe understand a little bit. Now we're actually going to start with some of the basics, and the whole course might be a little bit of a mess, but that's the dumbest way to go about teaching something, is to have absolutely no plan. So this is Trading for Dummies, hosted by the biggest dummy in the game. Let's dive into it. Okay, so first of all, in the last video, you probably didn't even know what this thing was I was looking at. This is an app called Trading View. You can look that up. It's a website, or this is just a trading terminal where you're going to be able to look at the candlesticks. And again, we were talking about those candlesticks in the last video of the price developing over time, right? We explained what candlesticks are. There's different patterns and whatnot. This whole course is not going to teach you any sort of strategies. It's just going to kind of give you the basics so you can start developing your own strategies on your own. I'm not going to talk about, you're going to hear different things like this is a cup and handle shape. It's all crap. It's all just dumb things that a bunch of other dummies are trying to sell you on so that they could sell you their own courses or their own strategies. All of this stuff that you hear online, it's all crap. Let me tell you that. First of all, what you want to do is develop your own system and then adapt it based off of inspiration that you hear from other people, okay? And I could be one of those people. It doesn't matter, right? So that's hopefully a little bit inspiring, telling you that you're never going to make it, and everyone who does this is wrong. It's a really dumb industry. But some of the dummies in this industry actually end up making money, and hopefully you can be one of them. So let's look. So you've got different symbols here on the side, right? And so this is the NASDAQ. The NASDAQ is, of course, a tech stock index, right? You've got the ES, which is, again, another sort of tech stock. Or no, sorry, it's another stock index for the US market. GC is gold. MBT is Bitcoin, right? And you'll have different pair names. So when you go on TradingView, you can type something like Bitcoin, right? And then you can look at that. Now you've got different exchanges on the side here, and that's going to be slightly different price variations. So what you want to know is there are different things. There's called futures, there's stocks, there's crypto, there's all these different things, right? There's Forex. So Forex is more of a decentralized thing where there's no central exchange managing the exact price. So you're going to see something like, if we say NASDAQ, for example, the NQ is the NASDAQ, right? So if you go to the NQ, this is futures, right? Futures market. Futures is a contract that expires in the future. Honestly, you don't need to know this shit, okay? It's a bunch of wasted time. What you just need to know is the ticker and how to use it properly. So these are called tickers, okay? Futures basically is the US market, okay? It's the CMEs. This is the exchange that's being used, the CME, okay? If you go to Forex, you're not going to see it, but you are going to be able, if you're trading on a Forex brokerage, you can type in US 100, or you can type in, NAS 100 or something. Depending on the broker, they're going to have different symbol names. They might say NDX 100 or something like that. It's the same crap, really, right? If I just type in here, I'm going to type it in US 100, right? There you go. It's they're CFDs is what it is. It's a CFD index, right? So indices, right? Sorry, I had Forex is just foreign exchange. So that would be Euro USD. So that's a different thing as well. Again, you don't need to know these nuances being a dummy, right? You just go in, you trade whatever the fuck you want, you follow the markets. And the reality is all this shit is here to confuse you. So it's more complicated. So that you'd lose money, right? And you're learning in the future here soon too, that all these indicators and all this jazz and different strategies, again, confuse you so you stay in the game longer so you lose more money to the broker, okay? Or you spend more money on courses that you don't need to spend money on. You always think that the next thing is around the corner, okay? All you need to do, being a dummy, figure out what you like, okay? And trade on that, okay? So I like the NASDAQ because why? Because I'm on the west coast of Canada and the NASDAQ opens at 6:30 my time. Whereas if I'm trading the Euro USD, a lot of the price action is going to be in the Euro time zone because it's a foreign exchange pair. So it's more of the volume is going to be at a different time. The NASDAQ is a decent time for me. So that's why I chose the NASDAQ. 6:30 a.m. is an okay time to be awake, not 5 a.m. or midnight, right? It makes no sense. Okay. Bitcoin is another thing that I trade because it's longer term, but there's not a whole lot of volume in it, right? A lot of people really like gold. That's another good option for you. Okay. Gold is going to flow mostly through the London and New York time zones, okay? Now, you might be talking about what the heck are the time zones, right? You might see, I've got these different boxes here right now, and I'm recording this in the evening, my time. So this is in the Asia session. So Japan has just woken up. So this box is just the time in when Asia is open, right? So this was Asia's trading hours, right? This is London's trading hours, and this is the New York trading hours, okay? So it just kind of helps me organize the charts so I can actually trade during those times. Gold is a really, really good option for most people. It also tends to have a just basically sort of up mentality, right? So it's a lot easier to trade because it trends a lot, right? Harder things to trade would be Forex because it ranges a lot more. But if you do end up liking that kind of range-based trading where you buy and sell, you know, off of ranges, much better in Forex world, okay? So brings us to the different markets. Once again, the crypto market is a little bit different. Again, sort of up mentality. The indices are a little different market, sort of up mentality. And then you can just pick and choose what you want. Now, there's a lot of weird things you're going to see. Okay, Dixie, that's the dollar index for the U.S. economy. You know, there's a ton of things that you can look at, different particular stocks, right? So these are the tickers for like Tesla, right? If you want to invest in Tesla, things like that, right? And you can set up on different brokerages, right? So your brokerage options are, you know, you have your local ones that are going to allow you to invest in stocks, whether it's like, you know, Robinhood or Wealthsimple or I don't know what the European one is. I forget, where you're going to just be able to buy individual stocks. And then you've got options for Forex brokerages. These are generally very common with European and African sort of traders because, you know, just different rights and regulations and whatnot. You might not be able to get in on the CME. Personally, again, I like to go on the NASDAQ on the CME and then trade futures, right? So I'm using a brokerage called Interactive Brokers, right? Because that's easy for me to set up, you know, and I can trade and it's fully regulated and all that jazz. So I guess what the heck is trading? Trading is just a battle between buyers and sellers at any given time, right? As people fill into the market, right? What happens is if I place a buy, right? That's going to cause the price to go up to the next order up, right? So people have resting orders everywhere. So you'll have maybe, you know, orders all throughout here. And I'm just going to kind of draw some lines randomly here. I think I can, right? So I'm just going to draw like order. Say there's orders all above, right? And there's orders all below. And you can place these orders as well. And what happens is they go into a liquidity pool. Okay, so some exchange, the CME or whatever broker you're using, they're connected to a liquidity pool and they have everyone's orders across the world basically resting there. And you know, they're much closer than this, but this is for a visual representation, right? And then when you click buy, what it does is it then sends the current price, the previous sold price, up to that level, okay? And then when the next person pushes sell, okay, they're going to come to this next level. So you can see how price ranges back and forth, but constantly new orders are being placed everywhere. So it's going to go to that next one. So if somebody comes in with a massive buy with a lot of volume meaning a lot of contracts or a lot of lots, it's going to eat up all of those orders and then the price will shoot up. So you get these kind of jolting movements, right? And then from there, you know, price might sell back down through these wicks, okay? So the price could jolt up and then the buyers could say, hey, or the sellers could come in and say, hey, no go, we're going to sell it back down, and then we're going to market sell it back down, and that's going to fill these orders back to down to that price, right? So if there's a really strong jump in price, a lot of times it's going to come back down because people want to take advantage of that good sell opportunity at higher prices, right? If it does spike up, right? So at any given time, it's a tug of war between the buyers and the sellers. There is something called the spread, which let's say this is the current price here, and the spread is the ask price, and this is the bid price. So the spread is the difference between the sellers and the buyers. There's always a difference, okay? And that can change over time and fluctuate. There's another thing people get confused with spread as well. It's called slippage, right? So slippage is what I was just talking about, where, again, if you're a dummy, none of this shit matters, but I'm going to say it anyways. It's kind of boring shit, and that's why this is the second video, not the first one, okay? Slippage is when somebody comes in and they place a massive order and there's no resting orders in the market. So if I go back here and I say, hey, I had, there's a bunch of orders here, but then there's a jump here, right? And I placed, 20 volume of something here, and there's only 4 there, right? Well, I'm going to jump up here and fill all of those 20 orders, and that's what's going to cause the price to jump, right? And you're potentially going to get filled. Your orders are going to get filled at a price that you're not happy with, right? And that's only really going to happen when you get uber rich and you're trading with massive volume in these markets. It is common on news events. So what are news events? Well, if you want to go, I'm going to just pull up forexfactory.com. You can pull up here. You can see some common news events here, right? Forexfactory.com, go to their calendar right here, and you can look at the calendar. So any given week, you can say, hey, these red folders, it means it's high impact news. It means it's going to cause a lot of volatility in the market. So the next news event is going to be at 11 a.m. and the FOMC is a really, really big one. Remember, FOMC and the NFP are really big ones. Those 2 acronyms. The NFP is the first Friday of the month, non-farm payroll, okay? And that's going to cause a lot of volatility. It's at 5:30 a.m. every single time. The FOMC is 8 times per year, and that's actually happening tomorrow, right? And the FOMC statement. So that's going to be a really, really big one. So that's the expected interest rates for the federal bank. So generally these news events you want to stay out of because there's going to be those massive jumps in spikes of liquidity, and it can really mess with your orders. Until you become, a little bit less of a dummy, we can actually avoid those. Guys, that's all I wanted to say for today. I hope you dummies caught on to something, or you might be a little bit too stupid. So if you're a little dumb, if you're a little bit too dumb, let me know in the comments, and I might be able to explain it to you guys, okay? But, I'm not very smart, and I've been able to do this. There's something else, guys. There's something called pips and ticks, and I've been doing this for a decade. They don't matter. It doesn't, I still don't understand how to calculate them, and they don't matter. But it's something that people use as a distance of movement in terms of how much price moves. I don't understand it. I've been doing this for 13 years. So you see how little you actually need to know to be a profitable trader.